Welcome, everybody, and thank you for taking a couple of minutes out of your day to spend some time with us here at United Prairie Bank and United Prairie Financial Network and chatting a little bit about investing in turbulent times. I hope you are all healthy and continue to be wealthy going forward. As an agenda, this is Mike Melby. There's a bio here for me, but you can only read that if you have trouble falling asleep. I do need to read a little disclaimer. I don't want you to take or construe anything you see or hear in this presentation as specific investment advice. And why? Because I don't know you, I don't know your needs, your objectives, your risk tolerance, etc. So I need you to consult with your financial advisor there at United Prairie Financial Network, and they'll work with you to take what I hope you learned today and implement it into your portfolio. The agenda today, we will talk a little bit about a review of turbulent times, and we're going to go back to 1970. We're actually given some of the recent events. I'm going to go back a little bit earlier than that. We're going to go back to 1968, and we'll come forward. We'll do about 50 some odd years of investment history and try to provide some perspective. And then we'll talk a little bit about investor emotions and expectations, and then end it with what you should do today. So as we get started, what you need to do annually, at the very least, meet with your financial advisor annually, revisit your goals and objectives, and make sure your asset allocation fits your risk tolerance. And the asset allocation, remember, is how you allocate your money or place your money amongst cash, bonds, stocks, perhaps precious metals, commodities, real estate, etc. That allocation is probably the greatest contributor to having a successful financial outcome. Then you want to understand the rationale for your investment strategy, plan, and choices. Your advisor should be able to tell you why you purchased every one of the investments you have. There should be a specific reason why you own it. It's either appropriate for the economic time, it's in a period of time where they're going to be coming out with a new product cycle, whatever it might be, there should be a reason that you own your investments. And as long as that reason holds true, it'd be very difficult to sell it because the reason you purchased it still holds true. So understanding the rationale of why you purchased something helps make your sell decision easier. And then we hope you'll set realistic performance expectations given the economic environment that we're dealing with, and then discuss how to prepare yourself financially and mentally during times of market decline. Now, if you only take away one thing from today, I hope you'll take away this little sentence here. Successful investing is the constant need to replace fear and greed with perspective, context, and patience. And this is even more important today with social media and the internet. We have all this information at our fingertips, but it isn't knowledge. And it's made it, all this information, the bombarding of information, has made it harder to be a successful investor, not easier. Because you have to have a basis from which to analyze and review and sift through all the information that's coming your way. And the only way you get that is to have a perspective on where you are financially and where you are on the economic cycle, and place that in context. And then, of course, have patience for it to work out. So let's get started. We're going to, as I said, I can actually take this all the way back to the 1900s if we wanted to do this for a couple hours, but we're not going to. Hopefully we can get this done in about 30 minutes. As I said, we had prepared this from the 70s going forward, but given some of the recent things that are happening, I'm going to include a little bit of the 60s as we look at these different decades. So we'll be going roughly 68 through today. So as we get started, the 1970s, let's back up. First of all, why is it important to know the economic history? There have been some studies that have shown that people's ability to tolerate risk or their interest in investing is tied to their first experiences as an investor. If your first experiences were really, really good, you're more likely to take relatively more risk than somebody whose first experiences weren't very good. Makes sense, and it's true. But maybe you need to look at your first experiences and see when it happened and place it in an economic time frame to maybe help adjust and understand why you make the decisions you make, and it may help you manipulate those decisions for more successful outcomes. So I'm going to go back to 1968. 2 years here that we covered, 68 and 79. These were years where our American system was jolted by waves of things coming out of, waves of things that threw us into economic and social turmoil. In 1968, the Vietnam trauma was continuing, and it was continuing against a background of racial tensions. Just the year before, American cities had burned in what was known as the long, hot summer of 1967, and a beleaguered President Johnson announced he wouldn't seek re-election. Then in April, civil rights leader Martin Luther King was assassinated at the age of 39. Rioting and fires broke out in more than 100 cities. It's not good, and what's going on today isn't good, but it helps put things in perspective a little bit. Then, of course, in June, Democratic Senator Robert Kennedy, seeking to take President Johnson's place, was assassinated as well. And all of America had a sense of despair. And that despair grew, and it turned over the political environment that we had. And the 60s as a decade were not particularly bad investment decade. Wasn't a bad investment decade, but it led into the 70s. And the reason I'm picking to start with the 70s is because an outside occurrence in the 70s threw our economy into a turmoil, much like the pandemic coronavirus has thrown our economy into turmoil. And in this case, it was the oil embargo. In fact, there were two oil shocks. There was the oil embargo, and then, of course, the fall of the Shah of Iran in Iran. So energy crisis forced cutbacks in energy-dependent industries. Unemployment reached 8.7%, the highest since 1941. We had Watergate, we had political instability, we had the oil embargo, the president resigned, the U.S. withdrew from Vietnam, New York City threatened bankruptcy. Mayor John Lindsay actually stood on the steps of the New York City building and threatened to put New York into bankruptcy if he didn't get a $1 billion bailout. And just to make things end on a nice note, we had the 3 Mile Island nuclear disaster. And we actually started the 70s with, in April of 1970 with the Apollo 13 disaster. So the 70s were a horrible decade when we look at reasons not to invest. There are other reasons the 70s were terrible. Disco and leisure suits. Now, I was, as a young man, I think I was 16 or 17, and I was trying to make a little money, so I was selling men's clothing at a big department store here in Arizona called Goldwater's. And for those of you who are of my age, you will remember making these really bad decisions, which was you would come into the store and the salesman would say, which leisure suit would you like? Would you like the Levi or the Hager leisure suit? And you'd pick the one you like, and then you'd get the exact same leisure suit in multiple colors. Yellow, canary yellow, lime green, dusty rose, which was a pink. Anyway, and they were all 100% polyester. We topped you off with a 100% polyester Huckapoo shirt, and out you went. Now, I tell that story to embarrass all of us, but also because everything we did was polyester. And of course, polyester was oil-based. Our economy was so heavily oil-based that the shocks of the two big increases in oil price really sent the decade into a turmoil. And it was a difficult decade to make money. And by the end of the decade, we were in stagflation. In fact, stagflation in 1979, it was a brutal period. We had inflation, hyperinflation, inflation greater than 6%, but without any economic growth. And in fact, after I got through selling leisure suits, I was able, after a few years, to start to work in investments. And my job then was to sell U.S. government bonds, 30-year guaranteed U.S. government bonds with 13 3/8 and 13 5/8 coupons. In other words, you were going to collect 13 3/8 and 13 5/8 for 30 years, and I couldn't give them away because you could go to your bank, you could go to United Prairie Bank, and you could get a 6-month CD at 15 or 16% and a toaster. Because everybody thought inflation was going to continue forever. That's one of the problems with stagflation. And then, of course, not only do we have stagflation, but the gas shortage. People forget there were actually marches about the price of gasoline. And then the other thing that happened, of course, the Iranian students stormed and seized the American embassy in Tehran, and they held 52 American diplomats captive for 444 days. And there was a feeling in the country that we'd lost control. And not unlike today, there was another country that was nipping at our heels to become the next world's economic power, in that case, Japan. And during the late 70s and early 80s, Japan was buying up everything. They bought up most of Hawaii, a lot of California. They were buying entire industries, and they were importing their stuff in like crazy. We were importing Nissan and Datsun cars and trucks, and they were smaller, faster, more fuel efficient than ours. And it was the end of American automaking as we knew it. In fact, there were books written about that this was the end of the American economic empire in the 70s. And by the way, we'd have $100 barrel gasoline till about 1990, oil, excuse me, and then we'd run out. You've got to be a little critical of some of the experts, particularly if they're writing national bestsellers, only because my guess is it's been pumped up a little bit by either fear or greed in order to sell the book. So anyway, if we take anything out of the 70s and the late 60s and early 70s, there was every reason in the world not to invest. And yet, if we look what happened to $1,000 invested from January 1st, 70 to 12/31/79, we see that you made some money. It wasn't easy, but you made some money. And if you had waited, you would have missed out on this. Let's go to the 80s. In the 80s, so we roll out of the 70s into the 80s, and we have hyperinflation going on, and a guy named Paul Volcker, who was chairman of the Federal Reserve at that time, got with President Reagan, and they literally forced us into a recession by taking all the money out of the money supply, the exact opposite that we're doing right now. They took all the money out of the money supply, forced interest rates to peak dramatically. There are people, maybe some of you on this call, who bought their first home and paid 18, 19, 20% interest on your home loan. And what happened then, because interest rates skyrocketed, it literally stalled the economy, forced us into a recession, but got rid of the inflation hysteria that we had. And it set the stage, that initial recession set the stage for about a decade and a half of pretty spectacular growth in our economy as well as in the stock market. But the 80s didn't happen without a lot of turmoil. Of course, we had Abscam, but the number 2 bullet point here, we had a year in which both the president and the Pope were shot. Think what the news cycle would be like today if that happened. And then, as I said, we had the worst recession in 40 years. The Koreans shot down a Korean airliner was shot down by the Soviets. The Iran-Iraq war started to escalate. We became a debtor nation for the first time. There was the bombing of Libya, a record-setting market decline in 1987, where the stock market gave up 25% in a day. And we had, at the end of the decade, bank failures peaking and the junk bond debacle. And yet, when we look at how we invested, it was a pretty good, and other than the 87 decline, a relatively stable 10 years. So again, any of those items we just outlined could have stopped you from being a successful investor. Let's look at the 90s. So now we go into the longest bull market in history at that time. Iraq invaded Kuwait. We had a recession here in the United States because of the Federal Reserve raising interest rates 6 times in a period of just a few months. The Soviet Union, our great nemesis, dissolved. We had riots in Los Angeles, the Rodney King riots. We had the worst floods ever in the history of the Midwest. And by the way, they're still the worst floods in the history of the Midwest, I believe. You guys would know better than I. And then the Fed raised interest rates 6 times, as I said, which led to the recession. The Dow tops 4,000 and then 5,000 too high. By the way, if the reason you're not investing is because the market is too high, that may be the worst reason ever. Because one thing you're going to see consistently through these decades is that with the exception of 1 or 2 times, and only in certain investment categories, the markets go higher. Technology stocks stumble. I think you remember that. We had chaos in the Asian markets, global economic turmoil, and then my favorite was the fear of the Y2K computer meltdown. I think you will all remember that we were literally huddled around all of our electronics, wondering our big, huge desktop computer, our big, huge cell phone. We didn't have cell phones then, maybe, I don't remember. But anything that was electronic, we were scared to death that when the clock clicked over for the millennia, it was going to stop working. Of course, none of that happened. So how did we do in the 90s? Well, it really was a spectacular decade. And let's go back to what I was talking about earlier, a little bit of investor psychology. If you had started your investing career, maybe your 401k in your first job, or maybe you took a little money you'd saved up and put it in the market, and the 90s were your experience, you're generally going to be an optimistic investor. If the 70s were your first experience, as a general rule, you'll have a bias towards pessimism. And it's important to realize what your biases are as you're making investment decisions. Let's go on to the next decade. This is where things get complicated. The new millennia. We had the closest presidential race in history, and then President Bush signed tax cuts plan as unemployment rises and the Federal Reserve cut rates. The terrorist attacks, 9/11. Remember what 9/11 was like. The stock market, the New York Stock Exchange closed down for a couple of weeks. Banks were closed. We didn't know if our economic system was going to survive that shock. Every plane was taken out of the sky. Every plane. And yet we managed to get through it, and we learned from 2000 and put in a lot of interesting things that have made us a safer country, both economically and just an overall safer country today. In 2002, the Dow dropped 3,381 points from its all-time high mark in 2000. That was the dot-com crash. We had the war on terror, of course, incredible uncertainty amid the market recovery. We had a mortgage and credit crisis. I think you all remember that, 2008. And by the way, we had great lessons from 2008 that have served us very well for this crisis, particularly in the banking sector. The global economic recession that followed, the Dow bottomed at 6,500 on March 9th, and that was less than half the peak of 14,000 just a couple of years earlier. And then the government started its first stimulus program. And the 2000s started with the dot-com bubble and ended with the end of the mortgage and credit crisis. Very difficult decade. Let's take a look. You actually have one instance here, aggressive growth, where you did not make money throughout the decade. You really crashed with the dot-com bubble, and then just about the time you're starting to make some money, if you were an aggressive investor, the chair was taken out from under you with the credit and housing crisis. And if this was your experience as a first-time investor, it may have biased you by being somewhat pessimistic. Is it really true that you can make money in the stock market? If this was your decade that you experienced your first relationship with investing, it wasn't a great relationship. You can see, though, that the incoming conservative kind of led the way. Very interesting. One of only 2 decades in the last 100 where you actually had one investment objective, not make money. Let's see what we're doing today, or the 2010s, excuse me, the iGeneration. A record 2.9 million properties foreclosed and the fewest new home purchases in 47 years. That was the residual of the mortgage crisis. We had quantitative easing round 2. We had the Arab Spring. Remember that? That was the hope that we would see some democracy and maybe even some capitalism in Egypt, and it was quashed. Greece near default. Then the Eurozone fell back in recession as U.S. equities generally moved higher. And in fact, throughout most of this decade, U.S. equities were the place to be. The Fed tapered down and then ended QE3. But then the Fed decided to raise interest rates from a 7-year target of 0 to 1/4 point to 2.5%, and then had to take it right back with before 3 rate hikes were taken back in 2019 because it stalled the recovery. If you remember, December of 2018 and then 2019 were very difficult years because of the concerns that the economy was stalling. But it did produce the longest bull market in history, and we did, leading into this year, had the lowest unemployment in 50 years. Let's see how we did. I mean, this doesn't have the highest return numbers, but it may have the least volatile charts of all the ones we've had here. It really was, it was a decade of slow but consistent growth, and that's what was reflected in these returns. So even a conservative income investor almost doubled their money, and an aggressive growth investor did very, very well. So let's take a look today. I want to show you something that will help you look at, put things in perspective. This is a wonderful chart. This is the intraday decline and calendar year returns going back to 1980. So the red dots are the low point during the year for the S&P 500. And then the bar is where we wound up. Or in the case of today, we were down 34% just a couple of months ago in the S&P 500. Now we're down 6. And as you can see, we've had a couple of years, 08 in particular, down 49%, 02, 01, 02, terrible years. But look at, for the vast majority of the years, we ended positive, and in some cases, substantially positive. In 2017, it may have been the least volatile year ever, down 3% at worst, and we wound up 19%. So we had a great year with very little volatility. Wish we had more of those, not likely to happen. So let's move along. So here's another quote I'd like you to spend a couple seconds thinking about. For every problem or crisis, there's an infinite number of forgotten or undiscovered solutions. And I think that's what's happening today. We are uncovering and discovering new solutions for the pandemic. And there are over 100 different drugs in trial for either vaccines or as treatment drugs. And it's happening in record time. But you know what else is happening in record time? I was on the phone today with PIMCO. PIMCO is the largest bond manager in the country. And they told me something very interesting that I didn't realize. When the Federal Reserve puts out these programs to buy different assets or to backstop different assets, the Federal Reserve doesn't do it. They go out into the marketplace and they hire the biggest companies like PIMCO or Goldman Sachs or Merrill Lynch to put these things in place for them. They don't make any money on it. It's pretty tight. But PIMCO was telling me back in 08, 09, while there was a lot of quantitative easing and a lot of money coming at the market, it took them over a year to put all that money into the market, to backstop all the resources. So in this time, it took them 2 weeks to put the money in motion. 2 weeks is compared to 1 year. And I think we're seeing the same condensed discovery and rollout period for some of the solutions for the coronavirus. So second quote I hope you'd focus on. Just as a story here real quick. We are big believers that we're in the 4th industrial revolution. And like the last industrial revolution, there are entire industries that are going poof in the night and new industries that are building up. And people are losing their jobs. There's economic inequality. And in the last industrial revolution, it was actually beginning of the ghettos. people came off the farms into the cities and there wasn't enough work for them. But what we need to learn about when we study all the industrial revolutions is that the solutions and the companies that come up with the solutions are the dominant companies for the next 5, 10, 15, 20, 25 years. And coming out of that last industrial revolution, we had U.S. Steel, we had AT&T, we had Standard Oil. We had these big conglomerates that came out and dominated their industries, much like we do today. And most of them were eventually broken up by the government, which may happen today with us. But when we look at, you want to be on the right side of the economic history. All of those decades we showed you, what you need to think about is, okay, are we in a hyperinflationary decade like the 70s? Are we in a declining inflationary decade like we are today? Do we have new industries being created overnight, new job opportunities, literally new businesses coming to light, and others that are going away forever? And the answer is yes. And we think that has to bias your investment decisions going forward. Let's take a look at what else we have. I want to spend a second on the CARES Act. So the CARES Act was the act that Congress passed, included about $2 trillion in relief. But the most important thing for most of us is that the required minimum distributions are waived for 2020. So if you're fortunate enough to be getting a required minimum distribution, and even more fortunate that you don't really need the money, you can stop that or take less than you normally would in order to let your account recover. 2020 is ignored for the 5-year rule for inherited IRAs, and you can take, if you need some capital, you can take coronavirus-related distributions from retirement plans and IRAs and avoid the 10% early withdrawal penalty that normally happens. So we're not giving you our tax advice here, but we think it's important that you know that you have some options that you should take advantage of. So what else? Well, I told you last we would talk a little about what you should do now. Now, you need to call your financial advisor. The two of you together should analyze your non-qualified portfolio. That's the money that you've already paid tax on to take advantage of tax swaps in equity and fixed income investments. I did that this morning for a client. We sold out of a municipal bond fund that was down a little bit, put them in a different municipal bond fund, generated a little tax loss for them. You can do that in both equity and fixed income. Upgrade your quality of your investments based upon what you and your advisor consider where we are in the economic environment and what's going on. It's an opportunity to upgrade. Think of the investments that you wish you would have purchased 2 or 3 years ago. They may still be on sale today. Discuss reduction or cancellation of required minimum distribution, as we just discussed, and discuss the options for accessing income from qualified accounts if you need it. So I want to end this, we got running just a little bit long, with reminding you of the saying that I hope will help you through this time when you're bombarded with economic information, when fear and greed are fed towards you, when the media has a if it bleeds, it leads mindset, that successful investing is the constant need to replace fear and greed with perspective, context, and patience. I hope this has given you some perspective and some context with which to work with your financial advisor to make successful decisions, and you will be rewarded with great patience. Thank you for your time and your consideration today.